As we teeter on the edge of 2024, the global economy finds itself in a precarious situation. Central banks in advanced economies are beginning to unwind the aggressive monetary tightening measures that characterized the post-pandemic recovery phase. The fading inflation shock, which gripped much of the world over the past 2 years, has led many financial institutions and economists to shift their gaze away from inflation concerns and toward risks to economic growth. Central to this global political and economic uncertainty is the U.S. Federal Reserve, which has recently implemented its first interest rate cut in years, a significant move that sets the stage for broader monetary policy shifts across the world. What we may be witnessing is not just the usual ebb and flow of policy adjustments, but rather a systemic shift in how central banks, particularly in advanced economies, manage the delicate balance between controlling inflation and stimulating growth. However, before delving deeper, it's essential to acknowledge the elephant in the room: the possibility of a global economic slowdown. Recent moves by central banks raise more questions than answers about the future trajectory of the global economy. According to Bloomberg Economics, borrowing costs in advanced economies could see an aggregate decline of nearly 40 basis points by the end of the year, with further reductions anticipated in 2025, leading toward a period of prolonged monetary easing. This coincides with growing market sentiment that sees the U.S. Federal Reserve as the linchpin for global easing efforts, with some outlier nations like Japan and Brazil potentially moving against the tide with rate hikes. Yet, the optimism over lower borrowing costs reflects a dark reality: fear of stagnation and recession, particularly in regions like the Euro area, Latin America, and even the United States, is pushing central banks toward policies that prioritize short-term economic relief over long-term sustainability. What lies behind this frantic rush to ease borrowing conditions as inflation ebbs? Simply put, stagnant growth prospects coupled with labor market vulnerabilities and mounting political uncertainty. While we may breathe a sigh of relief as inflationary pressures ease globally, this good news obscures an impending catastrophe. Economic growth momentum is fading, with central banks simultaneously caught between fears of stagflation and lagging output. Let's break this complex problem down into point-by-point issues. 1. The United States fiscal policy uncertainty. With the U.S. presidential election looming in November, game-changing uncertainties surround future fiscal policies. Both public and market players are deeply divided over how these policies could pan out, with potentially severe consequences. Let's not forget Donald Trump's key points of contention: tariffs, immigration, and tax reforms, which could undo years of fragile recovery. Already, the Fed has kicked off its easing cycle, cutting rates by a significant 50 basis points in a signal of prolonged support for an economy seemingly tipping toward recession. But Powell and other officials are treading carefully. According to the Fed's own projections from September, further rate cuts into 2024 could reach an additional full percentage point, cautiously dependent on labor market resilience and economic data. 2. European economic malaise. In the Eurozone, the European Central Bank, ECB, is set to reduce borrowing costs. A marked deceleration of inflation below its 2% target has hastened discussions around additional cuts. But with weak economic performance and the possibility of deepening risks, Europe remains vulnerable to a prolonged slowdown. Under the helm of Christine Lagarde, the ECB is navigating choppy waters. The region's forgotten demand problem is coming home to roost. The imbalance between wage growth pressure and stagnant demand across the Union's member states means that policymakers can only juggle so many balls: growth, inflation, and wages, before full-scale economic disruptions take hold. Underlying the recalibration of monetary policies from Washington to Brussels is one harsh truth: the global supply-demand imbalance that triggered inflation hasn't fundamentally changed, and now central banks are turning their attention to stagnating growth. However, stimulating growth in the midst of structural issues, be it declining productivity, unsustainable fiscal deficits, or aging populations across the G7, is a temporary solution at best. In fact, an overarching concern for many economists is that despite slashing interest rates, governments in large economies such as the US, Japan, and key Eurozone members have done little to address the structural drivers of long-term stagnation. We've seen this story unfold before. Here's a bitter pill to swallow: economic stimulus without corresponding structural reforms could trigger another debt bubble. Global debt is already at an all-time high, surpassing $300 trillion in early 2023, according to the International Monetary Fund, IMF. This warning can't be brushed away lightly, as several economies continue to stack up borrowing with little oversight on long-term productivity growth, the same pattern which once led to economic crises in past decades. Let's dissect 5 fundamental problems central banks are too often forced to paper over with rate cuts. 1. The disability of fiscal monetary cooperation. In many of the world's key economies, you'll notice the disconnect between monetary and fiscal policies. Take the U.S. While the Fed positions itself to cut rates further, federal fiscal imbalances, from unchecked government spending to debt-induced tax policies, threaten the thin veneer of sustainability. The Fed's own tightening was largely attributed to its failed battle against stimulus-driven inflation. Yet no coherent fiscal policy complement exists to focus on productivity or output enhancements. 2. Labor market vulnerabilities. Across the G7 and beyond, key labor market data indicates a looming problem. Declining participation paired with sluggish wage growth, compounded by automation and technological displacement. A cooling labor market is a top priority for policy response. But how meaningful is temporary stimulus to fix long-term dislocation? Let's take the U.S. as an example where despite cooling inflation, debates around minimum wage increases and potential unemployment spikes persist. Moreover, industries such as logistics and retail face slower hiring activity. Japan, too, despite planning rate hikes, recently revised future productivity targets downward due to aging labor forces. 3. Global supply chain realignments. COVID-19 revealed the world's deep reliance on fragmented global supply chains, and now we're witnessing an effort by nations to secure more resilient strategic sourcing. However, reshoring and diversification, such as the U.S. choking reliance on Chinese imports, could cause significant long-term price distortions. Nations are caught in a complex dilemma of balancing national security considerations while trying to lower borrowing costs and stimulate growth. 4. Energy security and investment gaps. Energy prices may have normalized temporarily, but the countdown to a future energy crisis has only begun. The global transition to renewable energy remains an economic afterthought in many countries, despite looming climate change risks and geopolitical energy flexes. Case in point, China, which recently implemented the largest stimulus injection since the pandemic began, is still reliant on non-renewable sources despite repeated calls for green investment. There's another layer to consider that deepens the economic malaise widely feared: political shocks. Though economics and politics often dance in a delicate waltz, today's political climate creates greater risks than simple disruptions. The U.S. remains the world's largest economy, and any significant change in its policies ripples throughout the globe. Depending on how the election unfolds, the markets may experience severe fluctuations depending on whether Trump or Harris secures the White House. Trump's consistent threats over tariffs and immigration policies, 2 key economic drivers, could force the Fed into tricky territory, making certainty impossible. Germany, the economic engine of Europe, is currently grappling with an energy crisis as it transitions to dependency on renewables. The fractured future sentiment is dominating the continent, and with Brexit still fresh in convention, Europe's stagnation risks worsening. So, where does this leave the global economy as we move further into 2024? Central banks, particularly those in advanced economies, face a delicate balancing act between easing up on soaring borrowing costs while simultaneously avoiding the risk of economic recession. These moves towards lower borrowing costs, catalyzed by the Fed, ECB, and others, will undoubtedly keep the world from plunging into a deeper economic abyss, at least temporarily. But the ball is set to drop eventually. The underlying drivers of growth haven't budged. Fiscal pressures, political uncertainties, energy dilemmas, and stagnating labor markets are still dragging down the potential for meaningful and sustainable recovery. Therefore, the immediate easing of monetary policies may offer a brief reprieve, but it won't be a miracle cure. The era of full reliance on central bank activism is drawing to a close, not necessarily because banks lack the tools to act, but because the root causes of subpar growth, structural imbalances, flawed fiscal policies, and political deadlock have created a new headwind. As we head toward 2025, the focus should be not just on steering central bank policies, but on aligning coherent fiscal policies, labor strategies, and global cooperation to heal an economy that can't yet stand on its own feet.